Okay, good day everyone. This is Capitaland China Trust financial results for first half 2024 dated 30th July 2024. Right, let's go through the key highlights. Alright, so basically there are 18 properties, alright, 9 retail malls, 5 business parks and 4 logistics parks, alright. Business and logistics parks are not doing well, alright. Retail malls are holding the REIT together. Right, so shopper traffic is up 14.1% for the first half year on year. Right, this is as opposed to 17.4% in the first quarter year on year. Right, that means the second quarter the shopper traffic improvement is less. Right, I estimate it to be around 10 to 11%. Right, so second quarter the improvement is less than the second quarter in the last year. Okay, so tenant sales is even worse. Right, over the first half year on year is up 6.6%. However, the first quarter alone improved by 12.6%. So I did a very rough estimate. So don't quote that. Don't quote my figure, but I roughly estimate the second quarter to have zero growth, right? Because first quarter alone improved by 12.6%. That means almost all these improvements in sales came from the first quarter, right? The second quarter is likely to be approximately zero growth, and to me that's quite disappointing. Okay, cost of debt is roughly stable at 3.49%, which is slightly above 3.47 reported the last quarter. Gearing is the same, right? So nothing to say, right? Overall gross revenue is down 2.3% year on year, right? This is for the whole portfolio. Retail itself dropped by 0.3% year on year, right? But this is due to the fact that they divested 2 malls, right? If we look at just the 9 mall comparison, the current 9 malls that they have now versus last year actually is a 4% improvement in revenue. Okay, so business park is stable, right? So I think that the occupancy has stopped dropping. Right, logistics is just bad because of the bankruptcy of the tenant reported in the last quarter. Right, MPI is down 4.9% year on year. Right, so they talk a little bit about retail again. So they're saying the retail again. If I just compare the 9 malls we had last year versus this year, right, MPI improved 6.1%. Alright, but overall is lower due to weaker logistic park performance due to the bankruptcy and also reduction in property tax incentive for the business parks. Right, so again, these two are dragging the REIT. Right, so DPU is down. If we compare first half 23 to this first half, right, and however, if we compare to last half, which we got 3 cents of dividends, right, it's up very slightly. Okay, so basically the reason why this one more or less held steady is because retail portfolio is doing okay, as well as there's 5.3% net financial cost savings amid the FX rates being stable, right? So previously this drop is partly due to the FX, right? That means Singapore dollar strengthened against renminbi, right? So from here to here the FX remains stable, so that's why the DPU is a bit more stable as well. Right, so year on year basis, the other issue is that withholding tax paid for the dividends is higher, right? So that's one of the other issues as well. Right, we look at the retail side. Not going to talk about everything, just that they did say that they might consider selling these 2 malls, right? Xing An and I don't know how to pronounce this mall. Sorry about that. Okay, but both were last quarter reported less than 95% occupancy, so it's the 2 weakest malls, right? This is the 4th smallest mall, this is the smallest mall, right? But this quarter, this one go back above 95%, right? But this is really small. Okay, so they consider selling to improve balance sheet and also to maybe buy back stock, because I think they believe that their stock is undervalued. Right, this one shopper traffic and sales we discussed earlier already. Not going to say too much about business parks. I don't think there's too much to say. It's more or less stable. The last quarter was 90.2%, now it's 90.5%. Right, the average occupancy in China for business parks is 67%, right, which is quite bad, right? And there's always a worry that the number of 90.5% will actually start to trend towards the average, right? But you can say the management is doing well to keep it at 90.5% as well, right? But the worry is deterioration in the near future, right? I'm not going to say so much about this. This one I'll discuss a little bit more later in the detailed sections. right? Financing, I don't think is a problem. All right, they are going to move more debt into renminbi. All right, I think we talked about this before in the last discussion on this REIT, so I'm not going to talk about it. Adjusted interest coverage ratio is 3, right? So this includes paying for the perpetual security, so it's relatively safe, right? So yeah, nothing much to say about that. I think we've sort of discussed this already, so I'm not going to talk about it. Right, adjusted NAV after distribution of dividends is 1.16 $1.16, right? The current price is 65 cents, right? So to me, if I want to value this REIT, I'll just value it purely on the retail side. Alright, that means to say the retail side brings in about 70% of the income, so I'll just use that as a benchmark to multiply by 1.16, right? And that gives me something like 81 cents, right? So I'll value this REIT at 81 cents, and the current price is something like 65 cents, right? DBS actually has a price target, right? So this DBS, what's the price target for DBS? DBS price target is a lot higher than me, alright? So 95 cents, alright? Okay, they estimate forward DPU to be 6 cents, which is roughly this half, 3.01 cents times 2 lah, alright? So, and that gives a forward yield of 8.8%, right? Based on, I think they came out with this on 31st July, right? Note that no recommendation to buy or sell, alright? Not financial advice, right? Just how I would value, alright? I'll value at something like 81 cents. Okay, so I'm not going to talk too much about finances. I think it's basically okay, alright? That's DPU. We'll just talk directly about yeah, so here they say that the AEI they've done has made significant contributions, but actually to me it's a bit disappointing. I'll try and explain why. So you can see generally occupancy in the retail side is quite good, right? It's 97.8%. Okay, even throughout the years it's been very high. Right, so the only one slightly below 95% is this one, which is what they are considering to divest. Right, the other one they are considering divesting is this one. Right, this one I believe is sorted according to size. Right, so this is the smallest. Alright, and this is the fourth smallest. Alright, I checked from the last report. Right, so I think this one is sorted according to size, if I'm not mistaken. Right, so anyway, you look at the portfolio rental retail portfolio leasing updates, right? Their renewal is not very impressive to me. It's like they say the new leases actually average versus average basis is actually down by 1%. The renewed, these are new leases, right? So the renewed leases is 2.5%. The portfolio average is up by 1.2%, and this average versus average basis. But if we look at the one coming in versus the one going out, right, is actually minus 1.3%. Right, so this one is based off the first period of incoming rent of new lease versus last period of outgoing rent of old lease. That means to say that actually they are getting less money, right? But I'm not sure if rent escalation is built in. That means to say sometimes they give the new tenants, right, offer at the start. That means the first year they pay the lease, and then the second and third year they raise the rent. Okay, so that's possible as well. That's why this one is minus 1.3%. Alright, so but at least this is better than the last round of minus 3.4%. Right, but overall I'm not very impressed by the rental revisions they are getting. Yeah, so I'm not going to talk about this. Right, business park, we'll just quickly talk about it. It's more or less flattish lah. Okay, I don't really have too much to say about business park. So far it looks relatively stable. Alright, is the logistics that is a bit of a concern. Right, so business park, I don't think this is a very good thing. The upcoming lease expiries, alright, this one is likely to all be reviewed lower because of the general over vacancy of business parks in China. Right, so this one I'm not positive on this part. Okay, so we'll look at logistics quickly, then we'll end the yeah. So here is the issue, right? This is the biggest logistics park and it's empty. Right, and I think they estimate that next 3 to 6 months is probably going to be empty lah. Right, these numbers are not including the empty logistics parks, which I think is not right lah. So if we were to include the empty logistics park, right, then this one would actually be 67.6% occupancy, and currently is 70.4% occupancy. Right, so this is the current occupancy of the overall business park. Logistics portfolio. Alright, so it's not good. Right, they're saying that this one, I think there's a tenant coming in, so this will go to 99% soon, right? So this support a slight positive, right? But overall, it will still be, I think, hovering around 70+%, right? I don't think it can go up by that much, right? So yeah, with that, I would say that if we look at just price, it looks undervalued, right? If I just value it on the retail side and I just throw away the business park and logistics park, it seems like it's probably valued at around 81 cents, right? So I'll tell you why I take 70%, right? Because the revenue 70% come from retail side, right? So yeah, I just took a rough estimate lah. I just based it on this one, right? Not the most appropriate way, I'm pretty sure, right? Again, it's just a rough estimation. None of this is financial advice. Thank you for listening.